Every time you buy a stock on your phone, there's a good chance someone already knows you're about to do it, and they're using that information to make money off you before your order even goes through. I spent years thinking the stock market was this level playing field where anyone could win if they just picked the right stocks. Turns out I was playing poker against people who could see my cards. And honestly, when I finally understood how this worked, I wasn't just surprised, I was kind of ticked off. So let's talk about some of the ways the game is tilted. Not to make you feel hopeless, because there are things you can do about it, but because understanding the rules, even the unfair ones, is the first step to not getting played. Here's where it starts. When you open up your favorite trading app and buy shares of, say, a popular tech company, you probably think your order goes straight to the stock exchange. It doesn't. Most of the time, your broker sells your order to a middleman called a market maker. These are massive financial firms that handle billions of trades. Why would your broker do this? Because the market maker pays them for your order. This is called payment for order flow. Your broker gets paid a tiny amount, sometimes just a fraction of a penny per share. But when you're processing millions of orders a day, those fractions add up to billions of dollars a year. Now you might think, who cares? My trade still goes through. What's the big deal? The big deal is that the market maker now has information. They know what you want to buy, how much you want to buy, and at what price you're willing to pay. And they can use that information to adjust prices ever so slightly in their favor before filling your order. Let's say you want to buy 100 shares of a company at $20 each. The market maker might buy those shares at $19.99, then sell them to you at $20. They pocket 1 cent per share. 100 shares times 1 cent is $1. Who cares about $1, right? But multiply that by hundreds of millions of trades per day across millions of investors. Suddenly, we're talking about billions of dollars flowing from regular people to financial firms, 1 penny at a time. This gets even more interesting when we talk about speed. Wall Street firms have spent hundreds of millions of dollars building what are essentially superhighways for their trading data. We're talking about fiber optic cables running in perfectly straight lines between data centers, microwave towers that can transmit information faster than regular internet, and computers located physically inside stock exchanges. Why does this matter? Because in trading, speed equals money. If a firm can see your order and react to it in microseconds, that's 1/1,000,000th of a second, they can adjust their positions before your trade actually happens. By the time you click buy, they've already moved. This is called high-frequency trading. These firms make money not by picking great investments, but by being faster than everyone else. They're like that kid in school who always got to the pizza line first, except instead of pizza, it's your potential profits. One study found that high-frequency traders make about $5 billion a year from regular investors just through these speed advantages. That's money that would have gone into your retirement account, or your kid's college fund, or that vacation you've been planning. Instead, it evaporates into the pockets of firms you've never heard of. But wait, there's more. Let's talk about something called dark pools. Despite the ominous name, these are just private exchanges where big institutions can trade stocks away from public markets. Banks and hedge funds love them because they can buy or sell huge amounts of stock without anyone knowing. Here's the problem. When a big fund wants to buy 10 million shares of something, that information is valuable. If word got out, other traders would rush to buy first and drive up the price. So they trade in the dark, where nobody can see what's happening. Meanwhile, you're trading on the public market with less information. It's like playing cards where some players get to make secret bets on the side that affect the game, but you can't see what they're doing. Now let's talk about something that hits even closer to home, the funds in your retirement account. If you have a 401k through your job, you're probably invested in mutual funds. These are baskets of stocks managed by professionals who charge you a fee for their expertise. That fee is called an expense ratio, which is just a fancy way of saying the percentage of your money they take each year. Some funds charge 0.03%, others charge 1% or more. That might not sound like a big difference, but let me show you what it actually means. Say you invest $10,000 and add $500 a month for 30 years. With an average return of 7% and a low fee of 0.1%, you'd end up with around $580,000. With a fee of 1%, that same investment becomes about $470,000. That's over $100,000 difference. Gone. Not because of bad investments, but because of fees. And here's what really gets me. Many employers only offer high-fee funds in their retirement plans. Why? Sometimes it's because the company managing the plan gets kickbacks from those expensive funds. Your employer might not even realize it's happening. But the result is that a chunk of your retirement savings quietly disappears into the financial system. Let's keep going. Ever heard of the bid-ask spread? When you look up a stock price, you actually see two prices. The bid is what buyers are willing to pay. The ask is what sellers want to receive. The difference between them is the spread, and market makers pocket that difference on every trade. For popular stocks, the spread might be just a penny or two, but for smaller or less traded stocks, it can be much wider. If a stock has a bid of $10 and an ask of $10.25, you're effectively paying a 25-cent tax just to buy it. Then another 25 cents when you sell. That's 50 cents per share that doesn't go toward your investment. Multiply that across all your trades over a lifetime, and it adds up. Now, I want to be clear about something. This isn't about Wall Street being full of villains twirling their mustaches. Most people working in finance are just doing their jobs. The system isn't rigged because bad people are running it. It's rigged because the rules were written over decades by people who benefit from those rules. When regulations are proposed to change this stuff, guess who shows up to oppose them? The same firms making billions from the current setup. They hire armies of lobbyists and lawyers to make sure the rules stay exactly as they are. So, what can you actually do about this? First, understand that you're probably never going to beat high-frequency traders at their own game. Don't try. Day trading and jumping in and out of stocks just gives these firms more opportunities to skim money from you. Second, invest for the long term. The advantages Wall Street has mostly work in the short term, microseconds to days. Over years and decades, those advantages matter less. If you're buying and holding for 20 or 30 years, the pennies they skim on each trade become a smaller piece of your overall returns. Third, pay attention to fees. If you have a 401k, look up the expense ratios on your fund options. Choose the lowest cost funds that match your goals. If your employer only offers expensive options, it might be worth talking to HR about adding low-cost index funds. Some companies have changed their plans after employees spoke up. Fourth, consider a low-cost brokerage that doesn't sell your orders for payment for order flow, or at least one that's transparent about it. Some brokers have stopped this practice entirely. A quick search will show you which ones. Fifth, keep most of your investments in broad index funds that track the whole market rather than trying to pick individual winners. This reduces the number of trades you make, which reduces the number of times you're exposed to spreads and skimming. Look, the stock market is still one of the best tools regular people have for building wealth over time. Even with all these disadvantages, investing in low-cost index funds has historically beaten keeping your money in a savings account. The game might be tilted, but it's not unwinnable. The key is knowing the tilt exists. Once you see it, you can adjust. You can play smarter. You can stop giving away more of your money than necessary. And honestly, understanding this stuff is exactly what channels like this one are for. If breaking down the hidden mechanics of money is useful to you, hit subscribe to Like Your 5. We'll keep pulling back the curtain on how this stuff really works.